correction or a by way of time correction, the way we are observing at the overall market level. So this, in my opinion, is a healthy valuation correction which we are undergoing. And because the long-term returns of any market is closer to nominal GDP growth, so if you assume now, as per budget, the 10% nominal GDP growth which we are expecting, so generally the listed names gives you plus minus 2% return, and equity returns can be additional plus minus 2%. So that kind of return profile is what is return expectation is what is to be considered in mind while equity investing in equity. While if you just go back in 24, the 3-year CAGR returns were upwards of 20%. In mid and small cap, actually it were upwards of 20-25% also. So that kind of returns were very high, and from that standpoint, they had to get corrected. In my opinion, now that broadly that correction is getting closer to the end, especially in the large cap, definitely the valuations are reasonable now. In mid and small cap, I don't want to separate it out as a mid and small cap, but in there also segments are emerging now with the reasonable valuation. Though as a pack, in my judgment, still it is at a relatively high valuation.
So you're saying mid and small caps still look overvalued in some pockets. Ashish, just talk about just the market perspective from here on, and I think that is the biggest question in front of investors. Many people kept saying, as we got into this valuation correction zone, that look, large caps are better placed, but as a habit, we Indians have always loved our mid and small caps, right? Because we think that's where the money is, that's where the alpha is. Now, that whole theory was challenged throughout 2025. Now we're in 2026, and I think that's the starting point for a lot of people, because they realized they were wrong. If they didn't pivot back to large caps, they missed out, and then they felt it's like a bear market. So I think 26 starting, that is the question. What should my allocation be between large caps and SMIDs, as they're called, small and mid caps? Ashish, your thoughts?
Absolutely. So yes, I mean, we saw, as Shreyash also mentioned, valuations had to sort of take a correction, and that's what we really saw throughout the year in 2025, because we had seen a great rally before that across large and especially mid and small caps. The valuations in the Nifty, if you see, were much more reasonable over the year, and hence the corrections in large caps, rather the movement in large cap was not as bad. But having said that, our premium to the AM peers was obviously much higher at the start of 2025, and that actually came down to the long-term average. So to that extent, even the large caps, from a global perspective, from a global investor's perspective, have become reasonable. On the other side, on the mid and small caps, they were expensive, and even now, the indices still trade at a much higher premium to their long-term valuation, and they're at a higher standard deviation also at this point of time. So obviously there are valuation pockets which are still expensive. The expectations is where the disappointments have come in the last 12 to 18 months, and hence we have seen more and more corrections in these pockets. Market being much more focused on near-term growth, on the fact that overall growth has been relatively lower, means that even good quality companies at various points of time have seen higher correction in their valuations if they have not been able to deliver the numbers that are expected out of them. And hence, this is something now things are getting better on an overall market basis. As I mentioned earlier, the bottoming of the earnings cut cycle is visible, and hence from here on, one can look at large caps much more focused manner. And in the mid and small caps, there will be selective positions that one can take. There are beneficiaries of various events that have happened even in the last month, even in the last couple of weeks, where, let's say, helped by the budget from the capex allocation perspective, some sectors have become more attractive. Also, we have seen there are areas in consumption which have been helped by the GST cuts as well as the tax cuts that happened last year. So mid and small cap can be an area which can be looked at on a selective basis, and exposures can be added where the valuations, as we call it, growth at reasonable price, have come, or reasonable valuations.
Okay. All right. We'll take a quick break on that note, gentlemen. We'll come back on the other side, and then we'll get the portfolio call, the portfolio queue, because the gentlemen on your screen are actually quite favorably inclined towards Indian equities in 2025. So we'll find out what makes them bullish, and also what should the overall portfolio construct be as we're looking at our plan for the remainder of this year and the next couple of years. Back with that in just a moment.
Let's talk money.
All eyes on Shreyas. मैच का लास्ट बॉल और ये
आउट। एक क्वेश्चन है, इनक्रेड से लोन मिलेगा?
पर्सनल बिजनेस
Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are getting the Axis Mutual Fund outlook on 2025 and why Axis Mutual Fund believes that this is going to be a good year for equity investors, and then therefore what should your strategy be? Well, we've got, of course, Shreyas Devalkar with us, along with Ashish. Shreyas, so let me actually start right there. And you mentioned a couple of points. Let's narrow them down. What makes you believe that 26 is going to be a good year for equities and that people should not keep chasing gold and silver and copper and everything else that they tried chasing towards the end of 2025?
So as far as equity is concerned, obviously always why equities asset class has been preferred more because of the inherent nature of companies and companies the way they grew along with the nominal GDP growth. To start with, nominal GDP growth, if you look at the budget, last year's was 8% and next year's is expected to be 10%. The companies tend to grow higher than the nominal GDP growth for multiple reasons. And if you take even that view, then next year, obviously, the earning growth is expected to be higher than the last year. So general consensus earning growth for next year is somewhere around 13 to 15% YOY growth compared to a high single-digit growth in last year. So that to begin with. Second aspect is when you look at multiple actions taken by the government as well as the regulator, and we are now seeing its benefits. Already multiple action taken by the RBI on the liquidity front, the rate cut front, and already we are seeing good liquidity in the system. We have actually started noticing that credit growth for the system has started inching up. In last 3 to 4 fortnight, actually the credit growth has started moving up. That is also helped by liquidity in the system, and that actually is one of the large sector or the segment by weight in the market. So if that segment moves up, then definitely it is a good tailwind for the market. Apart from that, if you take other sectors like consumption, now in consumption for multiple reasons, many sectors have seen lull over last 2 3 years. Uh, in this case, GST along with tax cut, and that impact we have already seen in the auto sector. Uh, Other sectors, there could be some delay because there is no one-on-one correlation directly to the GST cut because of the ticket size, and there are multiple things in that. But all in all, in my opinion, a good part of consumption is also expected to improve from here on. And more importantly, the recent cut in the tariff, the investment part or the capital goods part, as well as the manufacturing part of the stock market, that actually was facing some lull again in terms of performance in the last 1 year or so. Here there are multiple companies, though the exposure to US may not be very high directly, but there are multiple companies that have said that they have a potential to export. And when there was uncertainty on these tariff issues, the decision making was not being made. And now with this easing of the process, I think more and more decision making will happen. So even that part of economy will open. So when you see the multiple part of economy, when they start doing well, the exports, the consumption and investment, and that is the time when equity generally tend to give good returns. So the construct of the economy is such that yes, there is a good possibility that this multiple part may start delivering a positivity. In certain cases, the timelines will be elongated. So like in case of investment, or if FDI coming in exactly to set up a plant in India, it may take some time. But then one need to be patient with that, because these are not decisions like the FII. The FII flows, one can expect that there can be, and especially we have seen now recently that there is a good number which we saw yesterday. But when it comes to FDI, it generally takes some time, and that's where that investment and that translating into the economic growth, it takes some time. So if we are patient with this,
Sure.
then I think we can get good returns from it.
Sure, sure. I mean, that makes a lot of sense, absolutely. Ashish, on this, so that's a strong case for equities. You gentlemen have also laid out that it probably is going to be wise to, keep, a significant part of your investment in large caps within equities. Now, I just want to, come to also the question of sectors, and we only have 2-3 minutes left on this conversation. Sectors are always tricky. I mean, if you want to play a theme, either through direct stocks or through sectoral funds, then would you want to call out anything specifically for 26? And also throw in a word on